I want to talk to you today about the new corporation tax system that came in April of 2023. Why am I recording this video? Well, my day job is I run an accountancy firm, and I've been talking to clients over the last few weeks, and there have been these huge misconceptions about how this system works. Clients saying to me, I'm not going to be really affected by this. Am I, Justin? No. You're not understanding how this system works. And I've tried explaining it to a few clients, and to be honest, I've made a bit of a dog's dinner of it because it's really quite complicated. So I've really thought about it today, and I've created a PowerPoint. I'm not a massive fan of PowerPoint, but I've created a PowerPoint to really help you understand. And this is going to be really important for you to watch if you are a small business owner, particularly if you're making less than £250,000 a year in profits. So what is this misconception? Well, during the budget, the Chancellor said, companies with profits of under £50,000 will continue to pay 19%. So my clients are thinking, well, I'm not making a huge amount of money. I'm a bit over £50,000, so it's probably not going to affect me that much. I think you're going to be surprised when I actually show you how this works. Clients have been saying to me, it's a sliding scale, isn't it, Justin? You pay 19% on the first 50 and then it goes to 20%. And then, no, that's not how it works either. Clients saying to me, you only pay the 25% at £250,000. I'm nowhere near that. Again, stop thinking like that. Let's really drill into the numbers. So will you still pay 19% on that first £50,000? That's the $1 million question here. So let's have a look. What's happening here? Right. If you've got profits over £250,000, then you are going to pay 25% on all of the profits. You're not going to get a discount on the first £250,000 you make. You're going to pay on all of it. That's very important. If you are above that threshold, as long as you understand that principle that it is 25% on absolutely everything, then you probably could tune out from this video. But if you're in the middle, keep watching. What about if I'm making less than £50,000? Then great. Everything's going to be at 19%. And again, if you are not expecting to go over that £50,000, you probably can tune out now as well. But the people I'm really talking to today are those people who are making between £50,000 to £250,000. Then this thing called marginal relief is going to be calculated. Doesn't this sound exciting? So you get relief, so you don't pay the full 25%. So there is some good news in this, but I don't think you're probably going to be too happy about how it's calculated. Let's have a look at how it works. So if you've got £250,000 worth of profits, you're going to pay £62,500 in tax. That's 25%. Okay. If we've got £50,000 of profits, we pay £9,500. This is pretty simple maths, simple percentages. But the difference between £50,000 and £250,000 is actually £53,000 in tax. Therefore, there's actually a rate of tax here of 26.5%. And it's the difference between those profits. So if we took 53,000, we divide it by 200,000, multiply it by 100, just to create a percentage. We're dealing with fractions here fundamentally. It's 26.5%. Hang on, what? I thought you said the top rate was 25%. Well, herein lies marginal relief. So let's have a look at an example, and I think this will help you understand. If we've got a company that's making £150,000 worth of profits, the first £50,000, we calculate that as 19%. So we've got our £9,500 there. The next £100,000, we apply this 26.5%. So £26,500. So it's a total of £36,000 of tax payable with marginal relief. Again, if we just calculate a simple percentage here, 36,000 divided by that £150,000, it tells us what the tax rate we're going to be paying, and that's 24%. It's not a sliding scale like SDLT. I know I've mentioned that before. I need to drum this into you. I need you to understand it's not a sliding scale like SDLT. If you've ever bought a property before, you might have been familiar with kind of the first amount you pay 1% on it, then the next amount you pay another percentage on it. But that first amount of money, you still pay that percentage on. This doesn't work like that at all. We calculate this marginal relief percentage ultimately. This is the key thing, is by the time you get to £200,000 of net profits, the percentage is 24.625%. We're still £50,000 away from making £250,000 yet. We're pretty much at that percentage. You know, it just doesn't seem to kind of marry, and this is where clients are sort of getting really confused by it, because they're like, whoa, how can the percentage be that high, Justin? But this is how it works. I'm not in the game of discussing politics or anything like that. Ultimately, the government make the decisions. I watch the budget, I interpret these things, and I try to help my clients understand, not just understand it, guide them into strategies and ways we can actually help to avoid some of this tax by better managing our company finances. So let's explore this a little bit further. So how do we avoid it? Well, I've picked an example from a real client. The client is predicted to make £76,000 in pre-tax profits. So I was talking to this lady the other day. She's a single director, single shareholder. She's got a consultancy business. She's got some very specific knowledge, and she's in her mid-50s. And that's going to become relevant in a second. So first 50,000 at 19%, then the 26,000 after that to come up to that 76,000. She's going to pay 26.5%. She's got a tax rate of 21.57% when you consider all of those profits. She's going to pay £16,390. But I made a suggestion. I said to the client, I was like, you know, you're living on your own, you've paid your mortgage off, you're in a good position. Maybe it would be a good time to start really ramping up your pension input. You're trying to keep your earnings below £50,000 because you don't want to pay the high rates of tax, and you're leaving cash in your company. So why don't we put that extra £26,000 of profit that you've got, that's going to be at that higher rate of 26.5%, and make an employer contribution into your pension? Now the profits are £50,000, so she's only going to pay £9,500. That's a full saving of £6,890. That's a 26.5% saving. So you're kind of looking at this and going, well, I thought I was only going to save 21.57% because that's the overall. No. Because that next tranche of profit after 50,000 is at 26.5%, you're going to make a 26.5% saving. It's really, really good value for money. Let me give you some other ideas other than necessarily pension, in what you could do in order to try and lower down your profits and kind of reduce that tax burden. So here are some of the ideas that I've got. Pay for your life cover through your business. It has to be something called a relevant life policy. I don't know the ins and outs of it. I run an accountancy business. I'm not a financial advisor. Go and talk to your financial advisor and say, look, I watched this video. You know, what's all this thing about relevant life, and my company could pay for it. Makes a big difference. You're not paying for it out of your own personal tax money. It becomes an expense of your business. It's lowering down that 26.5%. It's a great thing to consider. Also, key man insurance as well. That's a great product. Talk to your financial advisor about what all that's about as well. Make sure your companies are protected as well. Electric company cars. I'm being asked all of the time about this. Just beware. Yes, we can write them off. If you're using them personally, then there's going to be a benefit in kind. You need to do a P11D. It's at 2%. It's exceptional value for money, but a nice strategy to lower down those profits as well. Makes it very affordable. Beware, there are some rises coming down. 25, either tax year 25, 26, we're going to be going to 3%. And then each year after that, it's going to be a rise of 1% up until 27-28. That's what's predicted. Other budgets might change the situation. Who knows what's in the pipeline? If you are using it personally, then unfortunately no VAT recovery on that purchase. If it's a pool car where all your employees are using it, it's kept at the premises, absolutely recover all of your VAT and claim that full capital allowance on it as well. Think about the timing of expenditure and capital purchases, particularly relevant. I was just talking about obviously pensions before. Actually timing a pension input just before the end of the tax year helps manage that tax burden. You should be using cloud technologies like Xero to keep your bookkeeping records. Look at those management accounts, see where you're at, what's the predicted profits. Go and talk to your accountant about it and think about, actually, I might be making an investment in new computer equipment in a few months. Well, actually, could we bring that forward and help with the corporation tax burden as well? And try and look into the future as well. If you've got a particularly good year and you think, well, actually, this is a good year to put into the pension, lower down the corporation tax rate. Maybe next year's not going to be so good. Think about those sorts of things. And of course, I mentioned topping up your pension. Sorry, I've made a typo there as well. And it must be an employer contribution coming out of your limited company. Do make sure that your pension company or your financial advisor understand your intentions there. It is really, really important. Just talking about pension contributions as well. Got a lot of clients that make lump sum contributions just before the end of the tax year. Yeah, it works, no problem at all. But do think about the pattern of the market. It's going up and down all of the time. Hopefully it's rising over in the long term on a kind of a nice upward trajectory. We would all like to hope that, wouldn't we? But there is a bit of a risk when you're putting in lump sums that you could, for a couple of years' time, your timing of your contributions of when the market is very, very high. So it can affect the overall growth for it as well. So actually making regular contributions, looking at those management accounts and thinking about what a sustainable amount is each month is a much better strategy overall. Finally, is a mix of salary and dividend still the right option? Been asked this a couple of times over the last few months. Yes, it is. As company directors and shareholders, we're probably familiar with being on a very small salary up to the national insurance threshold and then taking dividends for the rest of the amount. Yeah, it's still, there's not much in it. If your company is already using its employer's allowance for national insurance, then absolutely it's a yes for that one. So keep doing what you're doing. Ultimately, we've got more tax to pay. Unfortunately, this period kind of inflation we're going through, it's giving us a bit of a squeeze, I suppose, and it's we're wanting to take a bit more money. We're seeing a bit of pressure from the tax system there. The tax-free dividend amount has dropped. We've got a 1.25% increase on our dividend taxes as well. We've got this higher rate of corporation tax coming in. Particularly one of the things that's a hot topic with my clients at the moment is child benefit. If you are going above £50,000 only just, and you're starting to have to repay child benefit, you can be exposed to effective tax rates of over 60%. You must go and talk to professionals about this sort of thing and make sure you are doing the right thing. Consider any child benefit issues. Consider your pension capital purchase. All of those great things that I've mentioned. So I hope you've enjoyed that video. I've tried to keep it as simple as possible, but don't just kind of, I haven't got time to look at this. It's really, really important that you do look at it, and it will make a massive difference to you. Anyway, thanks for watching, and I'll see you next time.